My dear friends and investors, welcome to this month's video on markets and investing. But before I start, I would like to pay a tribute to our very beloved Mr. Rakesh Jhunjhunwala, or Bhaiya as we called him, who was a partner and co-founder in Alchemy Capital. It has been a great loss to the Alchemy family. Mr. Jhunjhunwala was a great mentor, a great guide, a friend, philosopher, an elder brother to all of us. I'm sure some of you have had the opportunity to interact with him during some of our Alchemy get-togethers, or because he was so accessible, I'm sure that at some point in time you would have met him in person. And for those who didn't meet him in person, I'm sure that he was close to all of us through his views on television. And I think we all have truly lost a great mascot of the India growth story, a man who brought the equity market cult to the Aam Aadmi. And today, we're going to talk about one of the fundamental and structural reasons why he was so bullish on India and why we as Alchemy continue to be very, very bullish on India. As you all know, over the last few months, we have been consistently messaging you that one of the big reasons why the markets have held up so well is because of the strong earnings growth story that we have seen. And we virtually talked about it in every communication. And even in this communication, we will talk about it towards the end. But today's topic is more about the financialization of savings in India. Truly, we have seen a big turning point when it comes to domestic equity flows into equity markets. We've talked about it, and as I mentioned, one of the structural reasons why Mr. Jhunjhunwala was so bullish on the Indian equity markets was because he always predicted that the amount of Indian money that will come into the Indian equity markets will far, far outpace what the FIIs have put in. And that is something that we will briefly discuss today. And I'll give you some data and evidence to back that. So if you look at the financial savings, which means that if you take the total savings of the country, right, our savings rate is about 30%. But there are three constituents in the economy which save. There is a household, which is people like you and me who save. There is the government sector, which is the savings of the government sector. And the third is the corporate sector. But what we will talk about today is household savings. And if you look at the trend over the last few years, household savings in 2005 was about 32% of total savings. That ratio fell by 2013 to almost 29%. But since 2013-14, that ratio is now 35%, which means that for every 100 rupees of savings that a household does, he puts 35 rupees in some financial instrument, maybe a bond, maybe an equity, maybe a mutual fund, maybe a fixed deposit, right? Maybe an insurance policy. And that's just 1/3 of his savings is today going into financial assets. The rest of the 2/3 still goes into land, gold, real estate or physical assets. And we think there is significant headroom for this financial savings to go up as a percentage of total savings. In many developed countries, financial savings is the bulk of the savings that household sector has other than the home. If we look at the domestic participation in the equity markets, we have seen a very steady upward trajectory. If you look at overall, for example, in December 2016, 13.5% of total ownership of the equity markets was by domestic mutual funds, retail investors, and HNIs. That 13.5% has almost gone up to 18%. And the biggest rise has come in mutual funds, which has gone up from 5 to 9%, and retail, which has gone up from 6.5 to 7.3%. And believe you me, as our demographics is so young, which means that more and more people are saving and earning, this ratio will only go up. As you all know, that one of the big successes has been the SIPs that go into mutual fund. In 2016-17, the annual inflows into SIPs was about 40,000 crores. Today, that number is well around 1,40,000 crores. If you look at the total flows by domestic institutional investors and foreign institutional investors, what we've seen is that in the early part of this decade, right, FII flows into the equity markets dominated the flows. And the performance of the market was fairly sensitive, or returns in the markets was fairly sensitive to whether FIIs were putting money or not, because they were putting almost 3x the amount of money into the equity markets compared to what the domestic investors were putting in. In fact, between 2009 and 2014, FIIs put in about 3 lakh crores over that period. And domestic institutional investors withdrew 1,20,000 crores. But that changed from 2015 onwards. And from 2015, we have seen that the domestic investors have put in almost 6 lakh crores, and the foreigners have taken out 4 lakh crores between calendar 15 and August 2022. But as you can see from the chart, the shaded portion from 2015 to 2022, that despite large outflows by foreigners, in each of those years, the markets gave a positive return, largely because domestic flows into equities became a larger and larger share of the inflows. And today, we can say with confidence that for every rupee or dollar of outflow, there is an equivalent inflow from domestic institutions. And therefore, the overbearing impact of FIIs on the Indian markets has gone down substantially. And why this is important is because every time there is a global macro headwind or an event, it impacts global flows through FIIs either selling or buying. And that impacts, at least in the short run, what happens to the markets. But what is going to be very interesting to see in the next table is if we assume that household savings is roughly about 22% of total savings, right? As I told you earlier, that India's savings rate is about 30%, but 22% is household savings rate. And in 2022, only 5% of that came to the equity markets, which was roughly about 260,000 crores, or if you convert it to dollars, about $30 billion. Even if we assume it goes up from 5 to 8%, and which is not asking for much, and you will see that the total amount of money that can potentially go into our equity markets could be 3x in the next 3 years. Yes, from 260,000 crores to almost approximately 6 lakh crores. Converted into dollars, that means $70 billion. And friends, the highest that FIIs has ever put in any single year in the equity markets is about 28 or 30 billion, which is exactly the amount of money today domestics invest in the equity markets. So you can imagine that 3 years from now, the amount of pool of savings available that goes into the equity markets will at least be 3x of what the foreigners put in. Now, I'm not saying that foreign portfolio investment is not important. I think every amount that comes into this country is welcome, and we do welcome foreigners coming and investing. And I do believe that increasingly, as larger parts of the globe slow down their economic growth and age, we believe India will be a very, very attractive investment destination. And therefore, I think one of the big structural reasons why we continue to be extremely positive on the Indian markets is because we believe that there is enough potential for domestic savings to flow into the equity markets. And that's no longer a conjecture, it's a clear reality. So friends, coming to earnings that we've been talking about, now that the first quarter is over, it would be interesting to see whether our hypothesis that the earnings remain to be very resilient is still true. So if you look at the NSE 500 companies, and if you look at the growth, top line growth was very solid at about 40% approximately. However, we saw a significant impact on margins. And as a result of that, PAT growth or PBT growth was only 18%, but still very healthy double digits. If you take out the banks and financial services, then the top line grew by 45% and the bottom line grew by 8%. But there was a 480 basis point of margin compression. So we've seen a very significant impact of raw material or commodity push inflation, which has resulted in almost 5 percentage points being shaved off of EBITDA margin compared to the same quarter last year. If you look at the same numbers on a quarter-on-quarter basis, that is between the March quarter and the June quarter, then you will see that almost 300 basis point impact. And despite that, if you take a 2-year CAGR, right, because there was COVID, but if you take a slightly longer range, even then you will see that revenues have compounded at 42% and EBITDA has compounded by 55%. So the earnings growth continues to be broad-based and reasonably strong. After this earnings season, we have seen that after 6 quarters of upgrades in the Nifty 50 earnings, last 2 quarters saw small downgrades in the Nifty EPS, but that was only to the extent of 3%. So now for 23, the Nifty earnings is likely to be close to 860 odd. And for 24, it is likely to be 995. And that's only 2 or 3% lower than what the earlier estimate was. So despite such severe headwinds on raw material prices, some of which we believe will come back in the second half of the year, the amount of Nifty downgrades that we've seen is very minimal at about 3%. And therefore, if you take 995 and if you take the Nifty today, which is about 17,700 odd, basically the market's trading at 18 times forward P, which is not expensive by any stretch of imagination, given the kind of strong earnings growth and where the economy of India is placed. And therefore, earnings continue to be a strong factor. But as we said for the bulk of this communication, that we also believe that the amount of savings that can come to equity markets will be humongous. And it will be one of the most important factors to drive this bull market over the next couple of years. Thank you, friends. Until we see you next month. Bye-bye.